There are a lot of sexy innovations taking place in the market right now, and HR software is not one of them. But that's good news for Paycom Software, who is a leader in this space and continues to grow methodically each and every year. The company just reported 10.5% revenue growth and a 24% EBITDA growth based on its very, very good operating leverage of this business. In fact, it's using a lot of its existing cash flows to repurchase shares, which could be good for its long-term investors. We addressed Paycom Software on our most recent 7 Investing subscriber call, which we're making freely available here on YouTube. If you'd like to learn more about all of our coverage of Paycom Software, check it out at 7investing.com/PAYC. Paycom Software, a review from back in February, we pointed out back then, 52% earnings growth off of 11% revenue growth. This is operating leverage at its best, right? Operating expenses were flat year over year in comparisons, even though you're getting that top line kind of growth. That's how you see earnings spiking off of much lower and much more modest revenue growth line item there. And then they were using the free cash flow they were producing, right? 18% of sales was translating into free cash flow. I called them a stock cannibal, where they're actually repurchasing a lot of their own shares. They repurchased and reduced their share count by 3% during the fiscal year. We had it as a buyback then. I think it's actually exactly the same story here as we fast forward to October. Roughly 8 months later, we're still seeing kind of that 10 to 11% revenue growth. In terms of EBITDA, not earnings, but EBITDA growth, 24%. You still see that operating leverage, still a very efficient organization. They raised their fiscal year guidance multiple times this year, which is fantastic. And then they continue to buy back shares in addition to paying a novel dividend out there. So the dividend's not rising. The repurchases are strong. The stock is down year to date in 2025. Good, but not great multiples. 32 times free cash flow is interesting, but I don't think that's one of my best buys right now. I'm going to keep Paycom as a buy with the caveat that we are seeing modestly rising unemployment, and a lot of the HR-related services that Paycom provides could be impacted by that.